All right, so perfect. So, hello everyone. This is Varun from Hashflow, also known as Gandalf the Brown, and today we are going to kickstart our first cross-chain swaps panel, and we have Bryan from LayerZero, and Victor from Hashflow, and myself from Hashflow as well. I would generally be moderating the panel and ask questions, but also uh, generally I like to make this a discussion so anybody can ask questions and we can all have a more candid discussion around the road to cross chain. And a bit more context, Hashflow recently launched their first bridgeless cross chain swaps that is powered by LayerZero. And we had a bunch of questions around how this thing works under the hood. So we figured this would be a good opportunity to uh, pick Bryan's brains around how they built LayerZero and then how we came to the design decision around integrating with LayerZero and what does the future look or entail. So that said, why don't we start with a brief introduction? We can start with Bryan and then Victor. You can give a bit of an overview as well about yourself as well as the project you're working on.
Cool. Yeah, for me, I think probably many of you guys know me by now. I'm Bryan, one of the founders of LayerZero, currently CEO of LayerZero Labs. Super excited to see more things getting built, and this one was particularly exciting. So I'm pretty pumped to just dive in. I think there's a bunch of kind of nuanced questions around it, and I think everybody will find it super interesting. And I still have some questions that I want to see get answered. So I'm pumped.
Awesome. I'm Victor. I'm one of the co-founders here at Hashflow, and I had the privilege of building most of our cross-chain architecture. A lot of it has been live for almost a week now. So you guys have hopefully had a chance to play with it. And yeah, I'm excited to be here and talk a lot about it. It's been a good ride, and the LayerZero tech has been amazing too. And yeah. Happy to answer questions and talk more about this space.
All right, no, excellent. Thank you, guys. So I was thinking perhaps it might be a good idea to start with a bit of a context or around the landscape of interoperability, and seeing exactly what's out there and uh, how do you guys currently view the cross chain space and what's happening, and then use that to sort of build upon how LayerZero came about and what were the shortcomings in the space, and then where do you guys fit in the ecosystem? Perhaps that's a question directed towards Bryan.
Yeah, sure. I mean, from our end, when we started building this, there wasn't really a cross-chain space. There were IBC as a messaging standard that lived, only in Cosmos. There was Polkadot, who was wanted to be the hub and spoke of everything, and there were a few bridges. But everybody's really focused purely on bridges. So moving, taking some asset from chain A and bringing it over to chain B, typically through this lock and mint kind of wrap synthetic method. So the goal of LayerZero had always been that there was no really need for the nuance between these things. Everything, very similar to the way that sort of messaging on the internet came about, was some form of general message passing, right? Bridging is just a special case of generic messaging. So we really started to build just that, a system that really is just meant to be this really extensible core primitive that anybody can build anything on top of. So if you have arbitrary contract invocations and you can pass payloads, aka messages, then you can really build anything across chains that the contracts themselves can support. So we didn't think there's any need to kind of create random arbitrary limitations at the technology layer. And so we started building that, and then obviously as it built, all of these other interesting questions came in terms of how do you actually build this as secure as humanly possible, kind of from the ground up? How do you give applications themselves the ability to specify kind of what they want to pay on kind of that curve of cost versus security? What does parameterization look like? All these other really cool things. But yeah, I think early on it was, we were just tinkering. We were building a game and then realized, You couldn't actually do anything in this game across chains without like a centralized contract that was coordinating. And then we were like, okay, let's look at bridges. They all suck. Like, let's make a slightly better bridge. And then like very quickly just realized like, oh, hey, kind of the thing that underlies all of this is this transport layer. And like, that really is the thing we should be working on. And then that was just, consumed our lives for the past 15 months.
No, excellent. Thank you for the response, actually. I was going to add a follow-up question there. I think oftentimes people use the term bridge and message passing synonymously, or they and there tends to be confusion between how you define a bridge versus what's a message passing system and what are all these terms, especially for newcomers who are coming in the cross-chain space. I wonder if you guys could kind of clarify how do you guys see a bridge? And I think that also goes into my next question around how is Stargate sort of different from the LayerZero's core protocol?
So most bridges, so again, like Stargate is a bridge. It's just a bridge that's built on top of LayerZero. Bridges are really trying to bring some unit of value from chain A to chain B. So there's like a couple different ways you can do this. Most of the historical ways in terms of a bridge was lock an asset up on chain A and mint a synthetic asset on chain B. And this is really tricky for a lot of reasons. One being that you might actually, have wild success and lock up a huge amount of assets and mint a lot of synthetic assets. And that seems kind of great in the case, but like an ideal world from a security perspective is that the user only really bears, and maybe I'm getting too technical here, hopefully not, that the user really only bears risk on the duration of the transfer. So, you're wiring money or you're doing whatever, like, maybe something goes wrong in the middle. You're taking on the risk of like that technology. But once the money gets there, or once your kind of asset gets bridged to the other side, you don't need to worry anymore. You have the real thing. You're done. That's all over. All the scary part's done. But now you have this synthetic. And so what actually happens is maybe, $10 billion of outflow happens. And so you lock up 10 billion on chain A and you mint 10 billion on chain B. But that risk, it never, ever goes away as long as that synthetic exists. So now you have your asset on chain B, but you're not done because there's still 10 billion locked in a contract on chain A. So now you have like two direct attack surfaces, three actually. You have local smart contract risk. So this is like the wormhole hack. There was a bug in the local smart contract. Somebody hacked it and, the money was taken. There is consensus mechanism failure. So maybe you have some chain that sits in the middle, some consensus mechanism that turns malicious. They can basically, mint an arbitrary amount of tokens on the other side, making your synthetic now worthless, or steal kind of the locked asset, meaning your synthetic is not backed by anything. That's a pretty terrible outcome. And then there's like fraudulent message where a hacker, stuffs a bunch of clever bytes in a message and tricks the contract to releasing money when it shouldn't. So all these things are kind of risk vectors. And so that was kind of the old bridge was, hey, we're going to do this lock and mint. But the problem is you're always carrying standing risk, always. And that is a really, really big concern because that can be, again, in the success case where this happens a lot, this can be like a systemic level of risk. And so the user doesn't just bear risk in the transfer, they bear risk for as long as they hold the asset on the other side, whatever they're doing, as long as that's in existence. And there's a lot of contagion there as these get integrated into lending protocols and DEXs and all these other things. So then we came up with Stargate, which is basically like native asset pools on both sides. So maybe you put up 100 million on chain A and 100 million on chain B, and users can like add to one and subtract from the other. And now from the user perspective, they're now only bearing risk for the duration of the trade, right? They add to pool A and they take from chain B, but there's no synthetic. They're getting the real asset on chain B. And the LPs bear all of the risk. And so, and they're getting obviously rewarded for doing this. And so now you could have kind of that same 10 billion of outflow while only maybe having $200 million in the pools, assuming you can rebalance them comfortably. And so now you have like a much, much more risk effective framing of way to bridge this. And then now, like with you guys and lots of other things, there's like even extensions on top of this, right? But I think the ideal case always is that you want in the bridging construct risk for the user to only be on kind of the duration of the transfer. Like that's the ideal case. Some things are unavoidable and you have to design around a lot of other things. But I think that's kind of been the evolution of bridges thus far. And bridges are really just, again, value transfer. Somebody's got a bag of money and they want to walk across a bridge and like land in the next place and kind of have their bag of money over there. And I talked for too long now, so I won't go into like the LayerZero specifics, but hopefully that's a high level on bridging.
No, I think that actually adequately answers a question for I think many people here, because I think that was more commonly asked questions around isn't this already a bridge? Speaking of which, I think this is a question for Victor. Right, obviously with Hashflow we market ourselves as a bridgeless cross-chain swaps, and I think this might be a good idea for you to kind of elaborate on Bryan's concept around why are we bridgeless, and how does Hashlow's architecture fit into the current paradigm, and then what makes this more unique in terms of how we enable cross-chain.
Most certainly. Yeah, so when you think of it, Hashflow does something that is very, very similar to Stargate, which is simply relies on messaging between two different layers in order to execute a trade, which means that similar to Stargate, the risk is bear by the LPs, and also the trader only bears the risk for the duration of the trade. So just to give a little bit more context, whereas in Stargate, say you're transferring things between Ethereum and Avalanche, and say you're having Tether on Ethereum and Tether on Avalanche, and you're going to say to transfer 1,000 tethers. Essentially, you're going to be transferring 1,000 tethers into the pool on Ethereum, and you're going to be debiting another 1,000 tethers from the pool on Avalanche to your account, right? Now in Hashflow, we extend that a little bit, and we use our market making infrastructure to be able to do something that is more like a trade. So it shares the same mechanics, it shares the same risk factors. However, what you actually get is a full-on swap where you can say transfer 1,000 tethers on Ethereum, but get AVAX in return on Avalanche, right? And I mean, we can dive deeper into this later, but essentially the reason we are able to do this is because we utilize the pool architecture, which is very, very common in DeFi, but we also use market making and signatures to enable guaranteed execution, right? So you don't have any crazy cross-chain MEV scenarios that you have to fear, but
so can like for everybody here and for myself, to be honest, can we just walk through like start at the beginning? You have some asset on chain A, you're going to some asset on chain B, like every step of the way. What does this look like?
Absolutely, yes. So say you're trying to trade USDC on Polygon for Ether on Ethereum, right? You're trying to buy Ether. What you're going to do first is request a quote from a market maker that is willing to make that happen. The market maker is going to be managing liquidity on both Ethereum and Polygon, right? So they can link the two pools and give you a quote. So suppose you're transferring 1,000 and you want to buy 0.3 Ethers, right? The market maker is going to issue that quote. It's going to sign it, and that signature is going to be specific to their pools, right? And what you're going to be doing as a trader is you're going to take that signed message, and that signed message is going to be a clear cross-chain trade. You're going to send it over to the Hashflow protocol, and you're going to send 1,000 USDC on Polygon. What the Hashflow protocol is going to be doing is it's going to be taking that, verifying the signatures, running a bunch more security checks, and then transferring that message over to the liquidity pool on Ethereum, which is owned by the same market maker, right? Via the LayerZero messaging protocol. So LayerZero is going to be, and Bryan's probably going to dive deeper into how this works, but LayerZero is going to be assuming is going to be providing message integrity, so that the pool the market maker has on Polygon can send this message that the trade happens to the pool that is on Ethereum. Once the Ethereum pool receives the message, it validates it further, and then it disperses funds over to the trader on the other side.
Okay, got it. So broadly, two pools or a bunch of pools managed by a market maker. But let's say we're using market maker A. That's who's given us a quote. We add it to their pool on Polygon. We're given a receipt through LayerZero. You bundle that up in a message. You send it over to the destination chain. then in your contract or, their contract, their pool within your contract, I guess, verifies that that's a valid message, all the signatures are valid, and then the funds are released. And so what this looks like from the consumer perspective is that, you have some consumer that's sitting on Polygon, they have Matic, they probably don't have ETH on Ethereum, or, they don't have whatever the destination gas asset is. They clearly don't have the asset they're trying to go into. And you sign a transaction from Polygon, you pay all of this in Matic on Polygon, and then kind of this whole flow gets executed in the background. So the user's not seeing any of this stuff happening. They're not switching wallets, not signing more messages or doing anything. And then, at the end of all of this, they just have ETH in their wallet on Ethereum. That's how it works?
That's right.
Perfect. Okay.
So actually, I had not a follow-up question necessarily, but I think actually it is a follow-up question. So I think generally the way I view it, right, so just to describe, you have market makers submitting, giving users a quote, and then there's a messaging system. And generally the way I tend to view the ecosystem is, or any cross-chain messaging, is you need someone to validate that the transaction has taken place on chain A, and then you need somebody to relay that information to the destination chain. And that's generally, I think, the formula for most cross-chain protocols to the way they work. And I was curious to see how LayerZero's messaging works, because I understand that you guys use Oracle and a relayer, and they have to work together in carrying the message. And I was curious if you would like to elaborate a bit more in terms of how LayerZero's message passing works, and how does it differ from other protocols like, say, Axelar or Wormhole and Nomad and such.
Yep. Yeah, 100%. So I don't want to, I want this spaces to be more about you guys than us.
Yeah.
Right? You guys built something cool, so we'll spend most of the time on that. Broadly, I will say kind of, and again, you guys, everybody who hasn't heard me talk about this before, you can find probably 1,000 instances of me doing so. But broadly, most of these other systems are reliant on kind of one consensus mechanism that sits in the middle. So you mentioned Wormhole, there's 19 Guardians. You mentioned Axelar, they have kind of their Axelar chain that aggregates all these light clients on there. But at the end of the day, there's a single consensus mechanism that deals with validating some source chain transaction and then sending out the destination chain. So broadly, kind of the concern with this is a couplefold. One, all parameterization kind of lives in that chain. And two, that chain is kind of, you're basically becoming this hub and spoke for everything. So ultimately that chain needs to be kind of more secure than everything on every chain that it's tying together. Because if there is an avenue for like an economically viable kind of attack on this, it has the ability, if that consensus mechanism is broken for even a very brief period, it has the ability to arbitrarily write messages universally kind of to every application on every paired network, right? So this is why, we've had hub and spoke models for a very long time. People have, this is not the first time this has broadly been tried. I think you have these really adverse properties of you secure a couple billion and then a huge application opts in, and now maybe it's 20 or 30 billion, and then Aave opts in, and now it's 50 or 60 billion. And unless the bond in the underlying system is growing kind of non-linearly to the value that's being secured, you have this, really adverse property where it's making each new application signing up is kind of creating a less compelling security construct for every existing application, because there's more and more at risk. Well, not in equal amounts securing that. And so broadly, how LayerZero addresses this is the risk is kind of sharded across this Oracle and relayer set. So, we're in self-proclaimed beta right now because we have a very limited subset of relayers and oracles that's going to be changing very soon. But broadly, you split all of this up. You give the applications autonomy such that they can run one of these components where you're effectively cross-referencing every single transaction that happens. So you have no unilateral control, but you also have complete control over security where nobody can do anything without you validating or cross-referencing it. And then, on top of that, there's a bunch of other kind of cool things. Again, I'm trying to be very high level here and not dive in too deep because I kind of don't want to make this about the LayerZero construct. But you guys tell me. I can spend 30 minutes talking about this. I've done it 100 times before. I think a lot of people on this have heard me talk about it before. But otherwise, we'll keep it as Hashflow centric as possible.
No worries. I think generally the way I see it is if there is an interesting information, especially for even for Hashflow users, sometimes they would care about what's happening under the hood in terms of security. So this information is usually useful. But I would like to ask one question to Victor here. Now that we've mentioned a bit of we discussed something about uh, message passing. I was curious, how did we arrive at the design decision in terms of evaluating different transport layers and figure out what works the best, right? What went into that thinking to evaluate different designs and why we ended up with LayerZero?
For sure, yeah. Um, so I think one main design decision was that we wanted to rely on something like interconnect, like pools on different chains that are interconnected by a messaging system, right? And it was pretty clear that this model would work well, the so-called bridgeless model. That being said, um, I do believe that um, the space is very the space is very early, right? And what that means is that a lot of the knowledge that's circulated is theoretical, right? Because even thinking of something like, okay, value that's locked in a bridge goes up, incentives of the attackers go up. People are going to be putting in a lot of effort and money to be able to hack something that holds, say, 10 billion worth of liquidity, right? So I think a lot of this is theoretical because we haven't gone there, and the space can evolve, right? So I think one of the things that we really wanted to do is to kind of assume that the system is very modular, right? We wanted to assume that we just have pools that communicate with each other, and how they communicate with each other doesn't really matter. And there are different ways to actually send these messages that we can plug and play, right? So LayerZero here becomes a messaging layer between two pools, but theoretically, it doesn't have to be the messaging layer. If I wanted to run something on my laptop and validate transactions, and the pools were totally okay with that, technically speaking, um, they should be able to opt into it. Now, in practice, that's definitely not something that we want to do, right? So then that brings us to the LayerZero design. Um, I do think that one unique thing about LayerZero is that it kind of relies on game theory to kind of to kind of mitigate this whole risk, right? It's a very modular framework. It was some of the early things that we noticed is that it does. There was a lot of research and a lot of thinking that Bryan and the team put into trying to figure out different attack vectors and different systems of incentives, right? And the system itself, the LayerZero system itself, was very modular, so it didn't actually lock you into a specific vendor, like specific Oracle, specific relayer. But at the same time, like with this modularity, it also made it very easy for users to onboard. So simple things like the testing suites were very easy to use. There are relayers and oracles that are easy to use out the box, right? So on the one hand, it makes it easy for you to onboard. On the other hand, it's modular enough and it has long-term security as as one of the main considerations, right? So for us, it was very easy to build. I think our architecture helped a lot because we didn't have to modify a lot of our code at the pool level to be able to support this. And yeah, I think it all kind of worked out, and we were able to build this quickly. And right now it's running in alpha, but the experience has been great. And yeah, does that answer the question, Varun?
No, it does actually. Yeah, it covers a lot of ground. I was actually curious to see, like, obviously we've assumed that generally we are relying on a relayer and an Oracle model, and obviously so far we're talking about the good case scenarios. But let's say if there is an adversarial scenario that exists, how does Hashflow uh, uh, or do we have any ways to mitigate those risks? Or what's the worst thing that could happen? What's the uh, in a doomsday scenario? What are we looking at?
Yeah, like Bryan mentioned, doomsday scenario is that someone corrupts the messaging system and anyone can send messages, right?
Hmm?
Um, Obviously, I want to say that there are risks that the LPs bear, right? And the fundamental risk between different blockchains is that them being different layers, they're vulnerable to 50+1 attacks, right? So I think we can't do anything about that. However, we can do something about the middle layer being corrupted, right? Suppose anyone can start sending messages through pools. One thing that the pools rely on is signatures, like they always have, right? So pools have to authorize each other and they check each other's signatures, which means that if you're setting up, even if you're corrupting the messaging layer and you're starting to send messages, you cannot really send correct messages that the pools would recognize unless you were to be able to forge the signer's private key on the other side, right? So in a sense, this is almost as secure as a intra-layer swap because it relies roughly on the same cryptography guarantees.
So is it safe to say that because we have signature checks in place, it's sort of agnostic to what validator and relayer set we use, given that both sides do a signature check? So it kind of really means you're using a validator and a relayer to do message passing, but it's somewhat agnostic to what kind of relayer or validator set you use, so long as they're offering you the latency, they're offering you good latency in order to achieve a swap.
I believe that's correct. Yes.
Right. Okay. So, in that vein, my next question was going to be, so because we talked about signatures, I think this is also one of the crucial elements why we are able to get around something called cross-domain MEV at this point, because previously MEV was a big thing when you were using AMMs and if you had large trades, someone with last luck on the trade was able to front run you. And now I think the moment we've moved towards cross-chain transactions, this becomes an even bigger problem. So obviously I would like to give you guys a chance to talk about perhaps what MEV is, just to define it a bit more for all the new people here who may not be familiar with the term. And then perhaps I'd like to hear your viewpoint on how did we go about solving for MEV. And Bryan, maybe if you had any thoughts on what's been the issues around MEV in the cross chain space.
Yeah. So MEV is minor extractable value, right? So this is broadly like some transaction is coming in and somebody wants to buy, $1,000 worth of something, and they say, I'll take a slightly worse rate, up to 0.5% slippage. Now the miner, seeing this happen, has the ability to insert their own transactions or kind of reorder these transactions however they like, and so they can put in their own transaction that brings this up to exactly 0.5% slippage, and then sell immediately after. So they've driven the price up, bought a bunch of tokens, you buy, which drives the price up even further, and then they sell after that at kind of the higher price. So they kind of taken some value over there. And this can be a lot of things. This can be, that's what they call like a sandwich attack, where there's all these ARB and triangle ARB and all these different opportunities that exist around the space. Basically everything, at any action that's being taken, you're slightly disjointing like fair value, quote unquote, and that creates opportunities. Again, oftentimes this is just arbitrage, but the person who is ordering these transactions or processing them has the ability to capture those. So this has been largely commoditized these days by groups like Flashbots and others who basically work with the miners. People auction off kind of what they're willing to pay for this slot. The miner gets paid from them, and then they sort of extract the value. So when you're building even on a single chain, this happens all the time, whether it's the Solana validator set or the Ethereum validator set or Avalanche or any of these others, right? They're kind of MEV, and all of these systems is depending on kind of the amount of control that the validators have in kind of ordering transactions. And so then when you're going cross-chain, there usually comes up this question of like, but hey, now we have 10 minutes or 1 minute or whatever kind of the duration is that you're waiting for this message to go through. Like, doesn't this create so much more MEV? And the short answer is no. And I'm sort of happy to sort of dive into why that is the case. But broadly, broadly, latency is not the biggest issue with this stuff, right? When they're measuring latency in a matter of, milliseconds, not a matter of, minutes or seconds. And so having like 1 minute, the way you create MEV is kind of having your order execution matters. And so if you knew something was coming in 10 minutes from now, some buy, you buying now would not help you at all because you would be disjointing the price. And then somebody else would use that dislocation to you would become the MEV for the next person. So it's really about being in the exact block positioning or as close as possible to when that event is happening, which still just comes down to the same thing prior. And there's some things you can do, you can submit to Flashbot's RPC on the other side. You can do other things to sort of lessen this as much as possible. But you guys don't suffer this because, at least my understanding of it, is that the quote is already happening and finalized on the source chain. So we've been thinking a lot about some other things that we might be doing kind of around, more broadly around systems like this. And it seems like if you're doing anything with value kind of across multiple chains, being able to have some sort of source chain quote where you have, so this was like Stargate's instant guarantee of finality, you have sort of price finality ahead of time. And then you're really just like the messaging and everything else is really just for settlement, right? And so when you have that, then you don't have this issue of kind of MEV because you've already agreed upon a price and it's kind of guaranteed.
No, that's absolutely true. Victor, if you want to add more color to it, but I think.
No, I think I second Brian's thoughts. I mean, the MEV. I mean, obviously we have a huge MEV advantage against most dexes, mostly because we have guaranteed execution. But yes, I think in a very sophisticated world, right, where people actually pay attention to activity and so forth, MEV kind of reduces cross-chain to single chain MEV. However, I do think that there are other challenges, obviously, that for AMM to function cross-chain.
Actually, just as like a quick aside, because I don't actually know how. So 2 questions: How do you guys guarantee? How do you guys guarantee execution? Like, what forces the market maker to act faithfully on the other end, or not being able to pull away the whole pool on the destination chain before the money gets there, et cetera? Is there some sort of bonding system, slashing? How is this enforced?
Yeah, I can give more color. So the market maker in general on Hashflow has to be trusted. So there are, you can think of market makers almost as money managers in a sense. So they would put their reputation there, take people's money, and then make markets with them in a sense. There are liquidity race scenarios, however, right? So obviously people can trade at the same time, and because transactions are not atomic, you cannot guarantee, for example, that certain balances are going to be available for settlement. We fix this by obviously making sure that we operate within certain bounds. So we wouldn't be operating the pools, or we filtering against, say, market making quotes that cut it very close to the line, right? However, theoretically, there's a theoretical constraint here where under the wrong circumstances, it could be possible for a pool to reach its balance limits. I think we use tokens. We use placeholder tokens. We call them H tokens to deal with that. Similar to how they rebalance pools for single chain transactions, where market makers keep part of the inventory on a centralized exchange for hedging, part of the inventory on Hashflow, and then whenever a certain token runs out, they kind of transfer over from the centralized exchange to Hashflow, and then from Hashflow to a centralized exchange. They would be transferring assets back into the pool as the pool runs out of balance, and then those tokens would be redeemable for those assets, right? So, for example, if you have only 50 USDC left in a pool, but then you have 2 trades at 100, the first trade is going to get 50 USDC and 50 H tokens, and those H tokens are going to be redeemable later on. And the second trade is going to get just 100 H tokens, which are going to be redeemable later on. So it does rely on the market maker honesty. However, market makers are KYC institutions. They're making markets operating on terms. So if there was a case where a market maker were to say take LP funds away, there will be legal action and so forth. So they're not incentivized to run away with funds, if that makes sense.
Okay, cool. Yeah, I got it. And the other thing I was going to ask about fees, but broadly, the market maker is just like they're just quoting a price, so there isn't like inherent fee. They're just like quoting some spread like they would when they're making markets on centralized exchange. So ultimately, anything that the market, any incentivization that the market maker is getting is coming just from filling a bid at a price that they were willing to basically operate at. Is that accurate?
That is correct.
Cool. Okay. Yeah. Okay. Go on.
So yeah, I mean, to that point, I think a lot of the people ask like, what comes in the of slippage, right? The reality is that every single fee, every single tolerance to price changes and volatility gets baked into the quote. So in very volatile markets, for example, you'll see quotes that have worse prices to say account for volatility. So that's roughly how it works. But at the execution level, once you get a quote, you have guaranteed execution of that particular quote.
Bryan,
you actually have guaranteed execution, or if the market maker doesn't execute, they will get in trouble, and you will have H tokens, which the protocol will fulfill, or like something will happen around.
In the single chain scenario, you have guaranteed execution. In a cross chain scenario, you have like you mentioned, pseudo guaranteed execution, where you have guaranteed execution as long as the pool has funds, and the protocol itself, the backend layer of our protocol tries to avoid situations where funds are out. If that makes sense.
Yeah, and you can always do something like Stargate does with instant, like the credit system, and making it so before they remove liquidity, they need to go back and kind of request from the destination chains, but it's a bit messy to do. So cool. Okay, yeah, Bryan, I broadly understand where we're at here. Cool.
So no, I think we have like 7 minutes left. So perhaps it makes sense to open up. We can take about 3 questions from the audience, and then before we call the wrap. So if anybody wants to ask any question, raise your hands up and perhaps.
Varun, are you able to enable the person to speak, or I have to do it through this account?
Bryan, can you go ahead, do it?
Sure. Okay. All right. First up, we have TLCB.
I don't think they got brought up as a speaker yet.
Okay, let me try to give Wallet 1 second. Okay. Yeah, I see that it's just saying connecting and it's loading.
Hey guys, thanks for having me. I had a question for Bryan. He asked Victor how, his part or his aspect was making sure that the middleman or the market maker was not exploiting the transaction. How does LayerZero achieve this? I just wanted to know. Thanks.
Yeah. So there's a couple of ways. At the messaging layer, all messaging is non-sorter enforced. So like the relayer has no ability to reorder transactions. So every transaction is basically submitted in the exact order that they were committed on the source chain for each application. And so, normally how this happens at like the validator level, again, is a validator gets like a bunch of messages that are incoming, and it just shuffles them around and says, oh, well, this transaction's happening here. I'll just, slip in this little bit of MEV by doing another transaction here or there and so on, right? But with LayerZero, not everything is coming in like this it's not like a constant stream. It's by block of source chain. So like you have a bunch of transactions that were in a single block on a source chain, and then you take all of those and guarantee transaction ordering. So it's nonce order enforcement, and the destination chain will reject them if they're ever submitted out of nonce.
Awesome, thanks.
Yep, for sure.
We've got 2 more questions. Anybody?
I'll ask a question while we wait. Feel free to like keep bringing people up as they have them. What are you guys most excited about for this? Like, what is the biggest unlock in your mind that this brings?
Victor, you going first, or should I go?
I have one thing that I'm really excited about, which is the fact that, I mean, the reason that I've always said this, I don't think we can have multi-chain without cross-chain. And I think this enables things like, for example, onboarding users. I think one of the biggest pain points is always getting things like native tokens to be able to start utilizing the chain. Then you have all these apps that are kind of separate, across different chains, and then you need your funds. You need your funds to do certain things, and it's just a pain to always get them out. So I think with more and more protocols that make this a little bit safer and faster, obviously, people will really be able to use a multi-chain world and not just transfer test funds to some of these blockchains, but also be able to move funds and work on different networks as they need to, right? So it makes this whole multi-chain space a little more seamless. At least that's what I hope.
No, I think I was going to say, generally, I think the thing I'm excited about is essentially, if you think about the things like Uniswap or other AMM designs that essentially brought the DeFi from 0 to 1, I almost view this as the next iteration, as 1 to N, on how do we scale DeFi to really get it to the masses, but also attract institutional capital and liquidity into the space. And enabling this sort of feature that allows people to not just swap within chains, but also swap between chains, and coupled with the design that allows for more modularity and bringing price discovery to DeFi, essentially means you can actually not just do cross-chain swaps, but also expand the suite of offerings beyond just trading some blue chips or spot assets. You can do things like options or ETFs and things like that, and now you can go and do these between chains and build out from there. Right, so that's sort of where I think this design works really, really well. And I think that's something that we've been really excited about building.
Awesome. Yeah, I agree. Super, super, super cool.
But I think we might be up on time. Unless anyone else has any last questions that we may have missed.
It looks like Nicole might be requesting to speak.
All right.
Okay, I've just added her.
Hi, friends.
Hello, what's going on?
Hello. Thank you so much for this conversation. I really enjoyed it. I'm learning a lot. My question is, what's next for Hashflow?
All right. Victor, you got to take this one, or should I go for it?
I don't know. I mean, I feel like we added a poll and everyone said Solana, so I'm like trying to figure out if it's Solana. So I'm waiting for it to come back online so I can start deving on it. I don't know. What's next for Hashflow?
No, we like Solana, by the way. So
yeah. I mean, Solana's definitely coming. I mean, just this is alpha here. Solana's definitely coming.
You just have to wait. You have to wait for business hours, right? Is that the new meme?
Yes,
But no, we also love Solana. We will be on testnet, on DevNet on Solana, like within 2 to 3 weeks. So like very, 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 very soon. So if you guys are going that direction, we will, have that all set up for you.
Yeah, no, I think the way we see it, we are lining up a series of new chain deployments. We're going to start with all EVM chains. So like including Optimism, Gnosis, and has Phantom as well, and then expand the suite to beyond non-EVM chains, including Solana and the Cosmos ecosystem, and so on. And then for my product milestone, I think we are going to put out a roadmap that will be more public facing in the upcoming week. But I think that's something to look forward to.
Okay, cool. That's really exciting.
All right. I think that might be it. We are 1 minute above time, but I think that was worth it, and I hope everybody else enjoyed and learned a lot from this first space. And we're thinking about doing this more often and invite more guests to talk about what's happening in the world of cross chain, because I think this is still very, very early and there's a lot to be learned. And I think this is something we could continue doing more often. But thank you so much, everybody, to come to stop by here, and looking forward to see you guys soon again next week.
Awesome.
Amazing. Thanks so much for having me, guys.
Of course. Thanks,
Thank you,
Bryan.
Bryan.